Friends, in this video for ithought Advisor, I'm going to talk to you on the topic why bottom-up investing still has a lot of steam. The last 2 years have been very interesting. We saw a massive correction with COVID, and from the bottom, we have seen one big top-down trade. Global liquidity, falling interest rates, fallen commodity prices, all set it up for this top-down trade. So when you had that top-down trade, almost everything that you bought went up. So we all were able to make much better outcomes than we did in the earlier 2 years. So we had a trade which was a top-down trade and a blessing in disguise. But market context changes when the factors which caused this top-down trade reverse. You have today rising inflation, rising commodity prices, and falling global liquidity. Clearly, we are going into a situation where the market context is taking an about turn. You are going to see a very different market over the next 2 years. We all are slowly reconciling to this. But how much are we taking into our investing? Where are opportunities still looking good? That is something which we need to introspect now. We need to factor in our minds that the context has taken a complete about turn. We need to understand that now it has to be a bottom-up trade and a company-specific hunt for opportunities. So the top-down trade which worked in the last 2 years may not continue for too long, or it may not be as successful in the next 2 years as it was in the last 2 years. Once you recognize that, you start thinking of what's the next best thing we can do. And in that search, I think it's very important to buy into businesses which will benefit from inflation, which will not be affected by falling global liquidity, and which can pass on commodity prices to customers. Or we could look at services where inflation will be having a lesser impact. Or we could buy businesses where the pricing power of the company is always stable no matter what the economic context is. Overall, you need to be very company specific. You need to know which company has better bargaining power, which company has prepared much better for this scenario, and which company is financially looking more attractive. Clearly, a bottom-up trade is going to be a compulsion for all of us. It's also going to be an opportunity. We tend to believe that the last 2 years was also a bottom-up trade because we like to think that it was our intelligence which helped us create these returns which have happened. But largely the last 2 years have been a top-down trade, and the next 2 must be a bottom-up trade. So in our mind, we need to first accept the last 2 years were top-down. Only if we do that, we will see the next 2 years differently. If we fail to do that, then we would be stuck in the same old thinking of the last 2 years, and that thinking will take us to places where we may not find the same advantages into the next 2 years. Effectively, a lot of steam is still left in bottom-up trades, in specific companies, in specific sectors, in specific special situations, in growth industries with long runways, in industries where near-term risks are scaring investors away, in companies where foreign investors are merely dumping and getting out, in IPOs which came at very high valuations and have already tired a lot of people and will further tire them because the valuation at which the IPO came is too rich and the company will still take a couple of years to justify that valuation. So all these factors are going to throw us a lot of bottom-up opportunities. There is a lot of steam left in the bottom-up trade. So whether you are under the able guidance of an advisor or a distributor or a portfolio manager, you must be sure that that person is taking a bottom-up approach to investing now and is going to look for specific spots or islands of opportunity where you can deploy fresh money to make superior returns over the next 2 years. The bottom-up trade is there and it's up to you to be a part of it. Thank you for watching this video.